Go belly up or kick the bucket, fall off the perch and beat your maker, pushing up daisies or give up the ghost, cash in your chips or listen to the crickets sing, pop your clogs or take your last bow, because whatever you call it, we should talk about it.
Hi everyone. It is a subject we don't like talking about, but it is one that we do need to talk about, and that's what this presentation is about. Mary Curie have given me permission to use that little video. Hopefully the tune isn't too catchy. This is just to remind me to tell you that I'm a chartered financial planner. I work for Westcott's Chartered Financial Planners, and I specialise in small, medium enterprises and micro businesses, particularly for directors, protecting the business in case something unforeseen happens, but also planning for the future in terms of pensions, things like SIPs and SASs and the like. So these are the learning objectives of today's session. Should be about just under 30 minutes. Any questions, then please email me when you get the chance, or give me a ring. Okay. So Legal in General, once every 3 years, come out with a survey, a State of the Nation survey about the state of small, medium enterprises, SMEs, in the UK. This was the last survey that they did, which was actually in 2021. So pre or in pandemic, I should say, 94% of businesses recognised they had at least one key person. Key person is somebody who, if something happened to them, the business is likely to be in financial trouble quite quickly or fold even. 75% of businesses have some form of business debt. That might actually be a debt to you, a debt to your family if you put money in to start up, or you've got directors' loans which haven't been repaid to you yet. 60% of businesses would cease trading within 12 months of losing a key person. And don't forget, the key person, often, if it's you as the person who's set up the business, running the business, you'll be doing the normal day-to-day stuff in the daytime, but you're probably also carrying on in the evenings. You may have started early in the mornings. You might even be working weekends. Often one key person would have to be replaced by 2 or 3 people. 75% of people have not heard of a cover called Relevant Life, or indeed executive income protection. I'm not focusing on those today, but let's just let you know that there are some covers. If you need life insurance and you're a director of a limited company, then rather than you taking it out through and paying for it through your after NI'd income, then your company could be paying for it, and it should be a deductible expense for corporation tax purposes. It wouldn't be a P11D benefit. And indeed, if you need income protection, so that's how you would be receiving your income if you were unable to work through a long-term illness, disability, incapacity, then that too can be paid for by the business, and that's called executive income protection. So in terms of who do you go to for advice? Well, the survey said that most people actually go to their accountants as their trusted advisor. Second place, I'm glad to say, is financial planners. So at Westcott's, we're very strongly placed because we are a chartered accountancy practice and business advisors. Part of the business advice is our chartered financial planning practice, which is me. We are independent financial advisors. So if we are recommending solutions, we do go to the whole of market. Via the internet comes next. As you can see, solicitors also very important in this process, because a lot of the time when I am talking to you, I need to know that you are also referring to your accountant and referring to your solicitor, your legal advisor, to make sure that any advice that I give you doesn't go off at a tangent to what is good for you in terms of tax and in terms of the legalities as well. So let's just demystify a little the sorts of questions I might be asking you before going on to giving you some indications of cost, and indeed then going on to giving you some planning advice about what you should be doing. So difficult questions, we do not like to talk about it. So what I would normally be saying to you is, okay, this is after finding out a little bit about you and your business, how it's set up. What would be happening today if you had died yesterday? Removing the emotions, just looking at your business. And then I'd just be quiet and let you talk to me. Sometimes people will tell me a lot at that stage and they will think it through. Other times I may have to just ask people and prompt them a little bit and say, okay, well, have you got a will? Lots of people don't have wills. I think it's about 75% of people in the UK don't have a will. So I'm never surprised if someone doesn't have a will, but it is particularly important that you have a will if you are in business, and also if you have children. I mean, let's face it, if you had died yesterday, if you had been with your partner and both of you had died, if you're a couple, then who is going to look after your children in the event of death? Are you going to appoint guardians, or are you going to let the courts decide who would look after your children? With a business, it's also really, really important to have a will. Who's going to receive your share of the business? What's going to happen to it? Does the person that's going to receive it actually want to run your business, or could they run your business? I might be then prompting and asking, do you have a partnership agreement? Do you have a shareholder agreement? And key to all of this, often, because the business owner is often the engine of the whole business, would the business continue today if you had died yesterday? Would anyone else be able to step in and run the business? I deal with quite a lot of family businesses, and often for a while when your father and mother have retired, they may step back into the business, but they actually want to enjoy their retirement. And the further they go into the retirement, the least likely they are to want to step back into the business. But they might actually still be dependent upon the business for part of their retirement income in dividends, or indeed still maybe drawing a salary as well, having their private medical insurance paid for by the business. Would the business be able to maintain its commitment to its lenders? Would it be able to pay back its investors? And don't forget, the investors might be you and your family. Would you be putting, if you weren't there, would the relationships with your key suppliers be jeopardized? How much would somebody need to be paid if you weren't here today? And as I said earlier, that may not just be one person. If it is just one person, you might have to attract them to leave their own business to come and work for your business. They're probably going to be in a job that they actually quite enjoy already. So you may have to pay over the odds for that person, or indeed you may need to pay for more than one person. It depends on what the context of your business is, but you may need a sales director, you may need a technical director, you may need a managing director, all rolled up as they are perhaps at the moment into you as one person. So that's one thing I would be asking. And when we've been through that, if that's not too much already, I would then be moving on to ask some other questions. I would then move on to ask what would be happening today in your business if you had suffered a critical illness yesterday. So what is a critical illness? A critical illness is something like a heart attack, being diagnosed with a cancer. It could be a stroke. It could be a number of different things. When we take out insurance to cover critical illnesses, it's important to know that there are definitions of what the critical illnesses that are covered are in the policies. So we need to look at that quite carefully to make sure we're covered. So if you think about this from a business perspective, if you weren't here because you died yesterday, well, that's one thing. If you'd had a heart attack yesterday, we all know that a lot of people might have a heart attack and be back to work in 5 or 6 weeks. They might not want to go back to work, but they may be driven to go back to work because they actually enjoy running their business. However, it might be for you, you would probably want to be able to step back a little bit and consider what is going on in your life and not be forced into going back into the business if you're not ready to go back into the business. So we need to think about what would be happening today if you'd suffered a critical illness. Now, when people take out critical illness cover, they notice it's a lot more expensive than life cover. So I will often be saying to people, when it comes to this, you don't have to have the same level of critical illness cover as you do life cover. Sometimes it's better to have a smaller amount of critical illness that is affordable by the business rather than the amount of life cover that you need, because the life cover can still be in existence and be independent of the critical illness cover. And again, if that's not enough, my third question is likely to be, what would be happening today if you'd suffered an illness or a disability, an accident, which meant that you were not able to carry on working, you were incapacitated? And we need to consider that because it may not be a critical illness. It could be a mental health condition, for instance. It could be lots of things that may mean you're not able to work for a period, a sustained period. How is your business going to continue running if you are the engine of your business? Or you may indeed have other key people that you need in the business all the time. I'm not going to go through all these again because they are very similar questions to the others. So what are the actual risks of dying, suffering a critical illness, or being off ill for a long period of time before you get to retirement? Well, thankfully, there are some calculators based on mortality tables and morbidity tables, based on experience of the life insurance companies. This particular one is with LV, that tell us what the actual risks are. And if you think about it, in our own lives, we will normally think about life insurance first. We may think about critical illness, but we might think that's a bit expensive. Very few people actually think about protecting their income. And actually, it's your income that pays for everything else. That should really be the first thing that we think about protecting before the others. So you can put in some details into one of these calculators. We can do this for you if you inquire. But this particular person, age 43, retiring at 68, I often actually pick on someone in the audience to do this when I'm presenting this. What are the actual risks of something happening to them? So I'm looking at my big screen when I turn over here. There's a 30% chance of being unable to work for 2 months or more before retirement. There's a 16% chance of suffering a serious illness, a critical illness. There's a 6% chance of dying before age 68 for this 43-year-old. There's actually a 38% chance of one of these things occurring before the 43-year-old gets to age 68. Now, you may smoke, you may not smoke. These days, when you're applying for these sorts of covers, life insurance, critical illness, anybody who's touched any nicotine product is classed as a smoker. And actually, the chances of dying if you are a smoker or suffering a critical illness or being off ill long term increase. So if that same 43-year-old had been a smoker at this point, then there's a 38% chance of being unable to work for 2 months or more, 23% chance of suffering a serious illness, and a 15% chance of death. Now, it may not surprise you to learn that for smokers, the costs of life insurance and critical illness cover are double that of non-smokers. Normally, to be classed as a non-smoker, you have to have given up all nicotine products for at least a year. But some of the insurers are actually wanting you to have given up for a longer period than a year now. And they do have tests. There's something called a cotinine test. And if you say you're a non-smoker and you're not, well, why would you do that? Because you want the insurance to pay out when it's needed. But if you did think, oh, I'll say I'm a non-smoker, they will do a test on you and they can test your saliva, basically, a cotinine test, and they can find out if you're a smoker or not. And don't forget, when you apply for these sorts of insurances, they will normally also get a GP report, a report from your doctor. And if you're a smoker, often your doctor will know that you're a smoker. So what do we use to protect a business? What recommendations might I make? Well, actually, it's not that complicated. Business protection is often dressed up to be very complicated, but we use similar products or insurances that we actually use in our own life. So just in the same way that when someone takes on some responsibilities in life, they may go out and buy some life insurance. I remember back in 1987, I took my first life insurance policy out for £20,000, cost £2.27 a month, I think it was, over a 20-year term. But that's something that will trigger people. It might be when someone gets their first mortgage. These are trigger events that make people think about responsibilities. Excuse me. So in our own lives, we will think about these things. We may think about critical illness cover if we've got a mortgage as well, because we want to make sure that we could live or pay the mortgage off if we suffered a critical illness. We may have thought about income protection. If we've been in employment before setting up our own businesses, we may actually have some of that cover paid for by our employers, and we'll know about that and we will value it. Well, in business protection, we actually use the same things. We use income protection or long-term income protection insurance, used to be referred to as permanent health insurance or PHI, you may have heard of it called that. And that is basically an insurance that in a claim when someone is unable to work, normally after a deferred period, the longer the deferred period, the lower the cost of the insurance. But let's just say the deferred period was 6 months because the business has some cash and it can keep going for 6 months. After 6 months, the insurance will start paying money to the business, every month until you're able to get back to work. Some of those insurances will allow the company to then pay that money through PAYE to the person who was insured. That then frees up money within the business to take on somebody else, perhaps. It can be done as a key person income protection policy, and that just means the business can use the money for whatever it wants to use it. That may be to pay you as a director. It may be to maintain dividends. It may be to go and recruit somebody to cover all of your business's commitments. So that's one of the covers that we use. The other cover, unsurprisingly, is critical illness cover. Now, most critical illness cover actually comes with life insurance included, but it is designed to pay out a lump sum normally if you are diagnosed with a critical illness. The main things we see being claimed for are cancer, stroke, and heart-related problems. 50% of us will get cancer in our lifetime. That's the statistics. Fortunately, for most people, the incidence rates of cancer go up as we get older, and actually a lot of men have cancer when they die, but they don't die of it, i.e. prostate cancer. So we are very concerned about these things, but there is insurance cover to pay out if you're diagnosed with a critical illness. Normally the term of these insurances will be determined by how long you intend to be in business. What's your exit plan? Are you going to be working in this business right up till retirement? Some people never want to retire because they enjoy what they do too much and they think they're going to keep going right to the end. And some people actually do that. So we determine the term often by how long you intend to be working within the business. Life insurance is the same product basically as you might take out as an individual. Normally we would use a term assurance. Term insurance just means that the insurance will pay out if you die within a set term. So as an example, if you are in business and you think you're going to retire in 20 years' time, then a 20-year term may be appropriate. If you are intending to be out of the business, or the business will not be reliant upon you within, say, 5 years, then a 5-year term might be appropriate. So term insurance doesn't have any built-up value within it. You are just paying for the cover while you need it. So these are things that you may be familiar with, but with business protection, the sums assured tend to be a lot higher. And if you are applying for these covers, you are likely to need to go through a medical. You may even have to go on a running treadmill for the ECGs. There will be in-depth medicals, but the insurance companies pay for all these things in the process. So in some ways, it's a good health check on you as you go through. So that's what we use. What do we use them for? Well, we call these things in business protection key person cover. We call them shareholder or partnership insurance, and we call them business loan protection. So I think I've talked about what key person cover does already. Shareholder partnership assurance is basically making sure that the company or individuals can buy the share of the ownership of the business from the deceased shareholders' loved ones, because it's likely that if the shareholder passes, that the remaining their beneficiaries, their loved ones, may have no interest in the business, may not know how to run a business, and it's unlikely, if you are the remaining directors or partners, that you will want somebody else involved in your business. Now, we also know that a lot of partnership agreements, the partnership might actually be dissolved on death. So you need to think about what will happen. And this is where the solicitors come in terms of writing shareholder agreements and partnership agreements. Business loan protection is a bit like when somebody takes out life insurance or critical illness cover to cover a mortgage. A business will borrow money, and often the cover that's put in place will be tailored to go down as the business loan goes down. Sometimes in a management buyout, there may be loan notes and structured loans, and sometimes the people lending the money will actually require for there to be cover in place because they're protecting their investment in the business. So these can seem a bit complicated, but fundamentally what we need to make sure is the right amount of money is going to the right people or the business at the right time. And I do often find when I'm reviewing existing covers, existing arrangements for businesses, that the cover has not been set up right. The intention may have been to set up the cover in trust for other people, but the trust documents have never been written. A trust is just a legal document that puts the money into the right people's hands, normally keeps it outside of your estate as well for inheritance tax purposes. Sometimes I even find that cover that is meant to be going to the business has been written in an individual's name, so it's owned by the individual, will become part of their estate on death, rather than having the cover owned by the business and the sum assured in a claim being paid to the business. So what next? This is something that is worth talking about. You'll probably want to make an informed decision as to whether you need these covers or not. The process normally goes along the lines of a chat, Teams, Zoom, sometimes in person, on the phone. However it is, me finding out about your business, about what's going on, then me providing you with some indications of cost. One of the first questions people have is, how much does it cost? So some indications of cost. You may have told me if you've got any medical conditions, existing medical conditions. Hopefully you will have told me about those in this process, because I can then talk to the underwriters at the different insurance companies before any proposals are made, just to make sure we know what terms you are likely to be accepted on, if not standard terms. So we do that. Then I put you in a position where you can make an informed decision. You can decide how much cover you need. Do you want the cover? Can you afford the cover as a business? Talk to your fellow directors, maybe. Talk to the other shareholders, maybe. Talk to your accountant. Talk to your legal advisors. Then we can propose the covers. And then we normally have to wait for a little while, because it's taking on average 60 days for a report to come back from someone's doctor. Often some cover can be put in place while we're waiting for those reports to come back. The insurers know these processes take a long time, and they will often offer cover while that process, the underwriting process, is going on. When all the underwriting is completed, then we will know what terms you're going to be accepted on. Hopefully you're accepted on standard terms, but if you're not, just remember it's because the underwriters have assessed you based on your medical information and think you are at a higher risk of suffering or dying in this. So your premiums are going to be higher for that reason, and that's the only reason they will be higher. Then you make an informed decision. I'll write you a report and recommendation so that you remember why you've done all these things. If you do have any questions, I've gone through rather quickly, please let me know by email or just give me a ring. I'll be happy to talk to you. Hopefully that's been useful, and it is a little bit longer than I expected, but that's often the way when I do these things. Okay, thanks. Bye.